Shatori, your favorite realtor with Attraction Realty, where I'm attracting you to your next home. So I'm coming to you live for Talk to Me Tuesdays. So for those of you know that I come live every Tuesday at noon to discuss all things related to real estate. So let's talk about how to finance a rental property. So I've had a lot of people reach out to me in the last few weeks asking me how did I purchase my rental properties. So today we're only focused on the residential side of it, residential real estate such as single family, duplexes, triplexes. So anything with up to 4 units, meaning one house with 4 units, with 4 doors. And so we will go over the different types of properties that you should be looking into and that will benefit you as an investor at a later date. But today we'll focus only on the financing aspect of it. So there's a big difference between owner occupant and investor homes, right? So a few weeks ago, I went over how to qualify for owner occupant home with the conventional or FHA. So owner occupant homes, you can qualify under conventional FHA loan programs where you put 3.5% down if it's FHA financing, or if you go conventional, you'll put anywhere from 3 to 5% down on average, plus any applicable closing costs. So owner occupants, a lot of new investors that's just looking to get their feet wet, they typically ask me, well, can I just do a conventional FHA and be an owner occupant on my investment property? And the reason why a lot of people choose this option because you put the less amount down, anywhere from 3 to 5% down, you have the lower interest rates and the lower requirements. Investors can do it as an investment loan, but it's much harder to pull off sometimes. They will not allow you to own rental property in an LLC. When you do it this route, you must buy the property in your personal name. So you will still use your personal credit and income to qualify. This will report on your credit report against your debt to income, and you will be fully liable for any issues that can go wrong with this home since it's in your personal name, okay? So some investors will buy in their personal name and then, try to quick claim it to change the name from their personal name into an LLC. The issues with that is that I found that is your title policy will be voided, which you've already paid for the title policy in the first closing. So now you can have issues later down the road with your title. And then there's extra fees involved for re-recording the deed from your personal name to the LLC. And then you have to configure the insurance and other things of that nature too. So yes, as an investor, you can use an owner-occupant loan. You typically have to make it your primary residence for 50% of the first year, 50% of the time for the first year. So I'm not a big fan of this option. I would rather put it in my business name, let the business be liable, and it doesn't tie up your debt to income ratio if you don't go this option. And for those of you that don't know, because some people think that they can just go buy a HUD home and turn that into an investment property, it is a felony to have a HUD home and you're not an owner occupant of it. So if you take this route of an owner occupant loan program and do conventional FHA, be sure to be able to prove that you have lived in the house for at least that first year for a majority of that time. With FHA, you do not have to refinance once you switch it over from an owner occupant to an investment property. But if you try to buy another home, you won't be able to get approved for another FHA. You can only have one FHA loan in your name at a time, and you would then have to go the conventional route. But keep in mind, your debt to income will determine if you're going to get approved for that second house because you already have this big loan already under your debt. So most would choose that option because, again, you're putting less money down. However, as an investor, if you're looking to purchase multiple properties, not tie up your debt, and lessen your legal liabilities, and be prepared to pay 20 to 25% down. So there's a few ways that different types of loans that we can look into. And so some of the major, some of the big options that you could choose is the local bank or credit union. When I say local bank, that's just your small local bank. It's not your big franchises, your big commercial companies like your chain companies like Bank of America, Wells Fargo. No, you don't want to go through those banks. You want to go through small local banks or credit unions. And this is just one of the best ways. So I use the credit union for one of my duplexes. And typically, if you look great on paper, you'll still get the good benefits of a conventional loan with the lower interest rates. But the beauty of it is that you can still put it in an LLC So you can put it in your entity name and it still will be a 30-year term, a 30-year fixed term. And again, it's still 20 to 25% down. However, you can at least put it in your entity name. Another way of doing it is using a non-QM loan. So most investors typically operate in non-QM loans. Requirements are slightly lower. It's perfect if you're not able to look totally good on paper. Like for instance, let's just say you can have the money documented, but you don't have the best credit. So if you don't look totally good on paper, they have ways of working with you. You still can do a 30-year loan. You can own it in your entity name. The interest rates are just slightly higher than going through the credit union, but you don't have to work directly with the lender, or you won't work directly with the lender, because typically you're going to work with a mortgage broker or a wholesale lender that works with the lenders to be able to get you those non-QM loans. And then last but not least is you have the portfolio asset base. So if you don't look good on paper at all, which most investors, is sometimes kind of iffy, is how you get your money and then being able to prove different things. But you can find a lender to focus on the property itself and not your personal financial statement. So portfolio lenders provide hard money loans. They provide permanent 30-year fixed loans, especially if it's a long-term rental or Airbnb. They will consider the possible income from it that you're going to make off of that investment. So the interest rates are typically much higher. It doesn't matter how many loans that you currently have, like with the other options that I just mentioned before, sometimes they put a limit on how many loans you can have open at one time. But with portfolio-based lending, most investors that are looking to do fix and flips, they will go this route. So this is a great option if you're doing fix and flips, or if you're looking for long-term rentals, then the portfolio-based option is the best. But again, for any of these investment loans, you still have to put 20 to 25% down for these type of programs. And if you're looking to do a cash out refinance, keep in mind that the down payment is about 25% down. So a lot of people always ask, well, what are my options for the down payment? That just seems like a lot to put down at one time. No, there are not any down payment assistance programs. You typically don't come across to where you don't have to put anything down. I haven't seen any investment loans to where you don't have to put anything down, unless you have some special creative financing to where you're just getting a loan. SBA sometimes have different programs, so if you want to use that money just to buy a house. However, you're going to have to put something down. One option that you can get creative with is seller financing. Seller financing is typically when you have a seller that just wants to be out of their mortgage payment. So they want to sell their house so they can sell it to you. You assume their loan and make the payments for them, and you could just assume it if the loan program is assumable, for where you could just put it in your name and transfer it over. But typically with those options, you don't come across those opportunities often, but if you do, it's not always long-term. So you kind of want to think long-term if you plan on having that property for a while. So the best option is to find a way to get the down payment. Some people cash out of their business credit cards. I've done that too. I've had several lines of business credit, and I just liquidated my credit cards and turned that money, just take the cash advances out, advancements out, and just put it in my business bank account. You can use other lines of credit. I've used a HELOC before on one of the properties. You can take that money out and use it for down payment. Some people choose to let to invest in a flip first and use the proceeds from their flips to pay for it. Or just find ways to save, or find other investments that can make you the money to put down. But the down payment is usually the hardest for most to come up with, but at least with paying 20 to 25%, you can have multiple properties if you think a long term, and they all can be owned in your entity's name. So to qualify for investor loans, typically, if your business has not been established and you don't have a strong business credit, you can be a guarantor for your business. And that's what most first-time business owners or new businesses, they do. You just be a guarantor until you can establish it. So meaning the lender will evaluate your personal credit, which typically needs to be over 640 and your income. So some lenders won't care much about the credit if you have the income. Like I said before, you have those QM and those portfolio-based programs to where you don't have to have the higher credit. It just depends. Depends on who's financing you. Different people can do different things. So they will evaluate your bank statements or tax returns. If you become a guarantor, your personal financials are used to qualify, but the actual debt does not go against your personal credit. It will only hit your personal credit if you default on the business loan. Okay, so that's one thing to think about. That's the benefit of being a guarantor. It doesn't go on your credit immediately unless you default. So when dealing with the lenders on investment loans for rental property, I highly suggest to work with local small banks, credit unions, and private lenders. Definitely private lenders, but don't even try to go with the big chain banks, like I said before. But those of you that's looking to invest, I will come on more often to discuss the investment side of things, so you will know how to invest, what makes a good deal, and knowing how to be prepared. So when the opportunity arises, you're ready to go for it. So don't see any questions. So if anybody has any questions, feel free to reach out to me. And that's all that I have for today's Talk to Me Tuesday. I will be back live tomorrow for Hump Day House Hunt while we're featuring home. And we shall see where the day takes me. Today and tomorrow, I am subject to be in the Ackworth Indicator area. So, and possibly Stone Mountain. So I will feature a home somewhere in between those two places. All right. So thank you guys for tuning in, and I look forward to speaking with you all soon.